Hello, friends. Today we're talking about Chevron Corporation, ticker symbol CVX. This stock is down 18%, almost 19% year to date. And the question is it a good buy right now? They just reported earning on October 27, and a lot of analysts are thinking that it's going to go somewhere around 170 to 190. That's about a 25 to 30% up. A lot of dividend investors like Chevron because of their high dividend of 4.2 right now, about $6. And they're actually announcing that they're going to be raising the dividend. We'll be talking more about that in a little bit. But for those that don't know who Chevron is a integrated energy company, which means that the energy companies or the oil companies are divided into three main segments: the upstream, midstream, and downstream. Upstream is the business that consists on the company when it comes to exploration and production of oil and gas. Pretty much is just finding oil and gas and getting it out. So then there's midstream, which is transporting them from the fields or from wherever it is to the refineries. They can use shipping, trucking, pipelines, or just for storage. And then downstream, it's whenever it's those companies that have the refineries and the gas stations. Refineries are companies that kind of transform the oil into products. So here you can see, and this is about normal. A barrel of crude oil is about 42 gallons. And out of the 42 gallons, it produces about 20 gallons of gasoline, 11 of diesel, 4 of jet fuel, and there's heating oil and all of those things. So Chevron is a company that is integrated, meaning it has all those three segments in their in their company. That's what they do, all of that. Chevron, like I said, just had their earnings and they missed. They beat on revenue, but they miss on EPS, which is income, but quite substantial. And that's part of the reason why you see a big dip right here. Right here, from here to here, there was a big dip. So one of the questions that we are trying to answer is this a good time to buy if you like Chevron? Full disclosure, I used to own Chevron. I sold it just because I think that there is a better oil company, and I'll make the next video about it. Chevron also announced that it agreed to buy Hess. Hess is a oil company, but it's only upstream, so it only looks for and takes oil out of the ground. They have agreed of paid about $171 dollars per share. That's about 53 billion. And the way that they're going to pay for it, they are going to I can't find it here. Here it is. They're going to issue approximately 370 million shares of common stock. So instead of using cash, they're going to be use equity. So that is going to be diluting Chevron. Well, kind of. What we're doing really is just, if you own Chevron, you're just gaining the kind of shares of Hess. Hess right now is valued at 44 billion, and you will be paying about 53 billion. There is about 7 billion in debt, which they will be assumed and they will be put into their books. Also, when they announced this, they also announced that their plan is to increase their dividend about 8% to $1.63 per quarter. So for those of you that love dividends, this would be good information for you to have. And then after that, they're going to try to increase the amount of repurchasing that they're doing and try to get so 20 billion per year. So they're going to try to repurchase the 60 billions that they're issuing pretty much just in 3 years, trying to bring it all back to it. So how is Chevron doing against ExxonMobil, which is the other big company? If you see in the last year, Chevron is down 18%, while Exxon is down about 1.5, and Hess, the one that they're buying, is up 7.3, which makes sense because remember, Hess is making money with the oil being high. Chevron and Exxon, they have other expenses on transportation, gas stations, and refineries. In the last 3 years, we can see that Chevron has gone up 63%, ExxonMobil 170, while Hess has gone up 200%. And in 5 years, Chevron has gone up 19%, while ExxonMobil has gone up 32%, and Hess 153%. So that's just little numbers for you to kind of take under account. Let's move into some of the financials in the past 10 years. Revenue, ExxonMobil Chevron and ExxonMobil and most of these oil companies are going to go up and down based on, of course, especially these integrated companies is going to be based on the oil prices. They're going to make more money. Of course, the more oil barrels are more expensive, and gas prices are also going to be influencing some of these revenues because Chevron, like we said, they own gas stations. So as you can see, it's up and down. And in the past 10 years, it has kind of stayed flat. It has dipped quite a lot. And earnings, one of the things that I don't like about Chevron is that they're very susceptible to bad times in the economy. So as you can see, they have 2 years that earnings went negative. 2020, that makes sense. And the earnings per share, it just goes up and down, just like we were talking about, based on a lot of factors. It's a very cyclical kind of company because it's tied to the commodity. But profit margins are staying around 9%. Free cash flow, it had been negative for quite a while and it has been going up. This is something that is really good, is that in 2020, they stayed free cash flow positive. And their free cash flow margins, it's 11.55. That means for every $100 that they sell, they keep about $11.55 of free cash flow. Book value has stayed up and down, kind of consistent. If you see in the past 10 years, it only has gone up 1.3%. The return on equity is a little under the 10% that I like. The return of invest on assets, it's higher than I like at 5%, so that's good. And return on invested capital is at 8%. Dividend, as we were talking about, is going up. In the past 5 years, they have returned on dividend. Their dividends have been growing about a 5.84%, and this not include the 8% that they're going to be asking the shareholders to vote on coming up in January. Liability, debt, they're pretty good. They can pay all their long-term debt in about 1 year with their average free cash flow. So that's very good financially there. Although remember, they're going to be assuming another, I think it's like $6 billion of debt whenever they acquire Hess. I was listening to their earning call, and they were saying expecting the transaction to be done by the end of somewhere in the first half of next year. So outstanding shares, as you can see, they issue shares every time that they're acquiring a company. I believe they acquired a company not too long ago, and these shares, I think the reason why it went up, it's because of the issues that we all had during COVID. They have repaid a lot of that, and of course, this is going to go up again. So outstanding shares is up and down, and when we look at the multiple valuation, this is whenever we take the last 5 years average of revenue, earnings, free cash flow, book value, and dividends, and multiply it by the last 10-year multiple, whether it is PS, PE, and so on. These are the averages. If you're looking to ignore the averages and you're just taking at the trailing 12 months, the fair value will be $144, which is what it is trading right now for. If you're looking at the average in the past 5 years, which is something that if you want to be a little more conservative, something that I will pay more attention to, is somewhere around $116. I probably will not be looking at the earnings because earnings go up and down a lot. It's very unstable, so I wouldn't look at it. And with that, the numbers are closer to 138 to 120. With that said, let's move to the payback time. This is if we were to collect the free cash flow for the next 15 years. I am putting a growth rate of 0. Let's just imagine that it doesn't go up, it doesn't go down. It just kind of stays in the average that it has been. The free cash flow somewhere around here in the 11, as you can see. Then if it's around 11, it will be $180, or if it's in the average, it's 170. I like that they're kind of close. The discounted earning valuation, if we were to take the earnings and grow them by 1% and multiply it by the PE and then discount it back, this will be the numbers somewhere around 88 to 50. I will not take this under consideration once again because earnings are so all over the place. Using the owner's earnings valuation, we have a average of $211, and year to date of 272. Whenever we put all the numbers together, we're looking at a fair value of 167, ignoring the earnings numbers on the high side, and an average of the 5 year, which is for me is my low side, of 144, which is where we are right now as a fair value. So that's if you discount it by 15%, that will mean that it is you will have to wait a little bit more to get to the 132. However, if you are bullish in the next couple of years, based on what they're doing, and you believe the analyst, you will be looking at entering right now and maybe making about a 15% in the next 12 months on the valuation. So, and selling it about 170. Although I know that most of you guys, if you buy Chevron, you're going to keep it for the dividend. So that will be, um, so if you're looking at the dividend, it's probably a buy as a fair value. So it's not discounted. Anyway, this is all that I have for you. I hope that you enjoyed it. Please remember, do not invest based on my advice. This is just a YouTuber giving you information and just my opinion. And if you like this contest, please subscribe and leave a like or a comment. Let me know where I screwed up. Have a nice one.